South Africa's Reserve Bank is expected to raise interest rates to 4% at its Monetary Policy Committee meeting today. According to a forecast, economists said the central bank would add 25 basis points to the repo rate this week, taking it to 4%, while some believe that the central bank would leave rates on hold. However, the consensus is that the central bank will later increase the rate in March. The MPC decided back in November to raise the repurchase rates by 25 basis points to 3.75% per annum. Forecasts show further likely hikes of 25 BPS in every quarter from now until the second quarter of next year, up to 5.25%. The central bank is then expected to pause for the rest of 2023. In a survey by Bloomberg, 15 of the 16 economists predicted a quarter-point increase and one a 50 basis points hike. Forward rate agreements starting in 1 month used to speculate on borrowing costs show traders are pricing in a more than 100% chance of a quarter-point increase. South Africa is likely to see at least 3 interest rate hikes in this year, as the Reserve Bank has indicated that it will begin unwinding its accommodative monetary policy stance. Today, we're looking at expectations for South Africa's repo rate. This is Business Edge. I'm Tolulope. Adeleru-Balogun. Joining me from Cape Town, South Africa, is Professor Roux. He's the head Futures Studies Program and the lead lecturer in economics at the Stellenbosch University Business School. Andre, welcome to Business Edge. Thank you so much for joining me.
Thank you so much for inviting me.
So we see that these rate hikes that South Africa is expected to get, even though they've started in late last year, are coming as the country seems to unwind what it's called an accommodative monetary policy. So let's start with that first. What exactly was being accommodated?
Well, if we have a look at the South African situation and indeed the global situation over the last, almost more than a decade, we know that over 10 years ago, there was a major financial crisis that hit most economies, plunging the world economy into a fairly severe recession. And then just as we were starting to unwind from that recession, of course, COVID-19 hit us, and we plunged into an even deeper and more severe recession. So over the last decade or so, in many parts of the world, monetary policy has been accommodated, along with, at times, fiscal policy, in the hope that it will stimulate consumers and businesses to come back to the party and start spending more money. And what was interesting is that despite interest rates in parts of the world reaching historically low numbers, sometimes 0% or 0.1%. Despite that, until recently, inflation remained fairly well under control. It behaved itself. Here in South Africa, although the level of interest rates is higher than many other parts of the world, we also saw until recently almost 40-year lows in interest rates, the prime rate reaching as low as 7%, which for us is fairly low, with the same kind of fundamental intention, and that is to try to stimulate and to drag the economy out of these severe recessionary conditions.
Okay, so if we now fast forward to where we find the MPC today as it is expected, what factors are making it necessary or even possible right now for the Reserve Bank to consider raising rates, even though we did see some upward movement in November?
Well, I think we need to look at this from at least 2 perspectives. First of all, let's have a quick look at what the actual mandate is of the Reserve Bank. As determined by the constitution of the country, it says that the primary objective of the Reserve Bank is to maintain the stability of the currency. And that is interpreted to mean that the Reserve Bank has to ensure that inflation remains within acceptable levels. Now, accompanying that is the question of inflation targeting. So in this country, we have a target range of between 3 and 6%. So all of this means is that complying with the Constitution and looking at these inflation targets, that whenever the Reserve Bank feels that inflation is going to breach the upper end of the target range or show signs of doing so, it is virtually compelled to take action. And typically that action is to raise interest rates so as to slow down the demand for credit. So that is the almost the institutional imperative. At the same time, no country operates in a vacuum. No country is an island. So we have to be aware of and take note of global trends. So we see, for instance, in the USA, inflation towards the end of last year hit 7%, the first time in more than 4 decades. And recently, in fact, just a couple of days ago, the Federal Reserve indicated that as from March, they're going to start raising interest rates. In the UK, inflation is around about 5.5, 5.6%. Again, a recent historical high. They too intend raising interest rates. So in keeping with the global relaxation of accommodation or tightening, one can understand that we are looking in the same direction, especially to protect our exchange rate from depreciating significantly. Here in South Africa, and I mentioned a bit earlier that the target range is 3 to 6%, the latest figure is 5.9%. And that's probably that which prompted the 25% basis point increase late last year. And we have to consider that from the Reserve Bank's point of view, inflation still probably has some upward momentum. The oil price, as we were seeing very recently overnight, breaching $90 a barrel. We know that throughout the world, there are supply side constraints, supply chain constraints, which is reducing or increasing the gap between demand and supply. Here in South Africa, wage increases lie ahead. So chances are that the Reserve Bank's models are indicating that unless they take action, inflation could burst through that 6% level and become uncontrollable. So they are probably taking what we could call an incremental approach, being preemptive, looking at a series of small increases rather than waiting too long and then having to introduce a massive increase, which would be awfully painful. However,
okay, go ahead, finish that point.
I was going to say, however, the counter argument could be, well, that's all very well.
Yeah.
But let's look at the real economy. Economic growth in this country, like many other parts of the world, in fact, even before COVID hit us, this country went into a recession.
Yes.
Naturally, COVID exacerbated that. 2020 was awful for everybody. Last year, economic growth probably around about 4.5%. But that's a little bit of a mirage, really, because that's simply rebounding from an awfully low figure in 2020. The expectations for this year, next year, are barely, well, not even 2%, 1.9% this year, 1.4% next year, which really is hardly worth mentioning. Add to that, massive unemployment, 35%. Yes. And add to that the fact that consumers are really being squeezed. One could argue that interest rates should not increase. But the Reserve Bank tends to be, in some ways, hawkish, and they are true to what the Constitution demands of them, which is why, on balance, we're probably going to see this afternoon, in a few hours' time,
yes,
a small increase and a number of further increases during the course of the year.
And so you sort of wrapped up my series of next questions, because I wanted to touch base on, given the fact that there was a bump in November that took the interest rate to 3.75, now an expectation of a bump that will take it to 4%. But you've explained why that's happening, rather than waiting out for a huge increase that will come. But I want us to go back to that economy one. So as you said, Nigeria, I beg your pardon, South Africa experienced a recession right before COVID-19 came out of it. Some would say that there's still the tailwinds of the recession right now in the economy. Highest unemployment numbers ever since Stats SA has started taking the statistics for South Africa. Contraction as well, with the economy shrinking by 7%, or I'm seeing the GDP shrink by as much as 7% in 2021. What does this realistically translate to for the South African? Even if this is, as you said, the Reserve Bank being hawkish and doing what is their constitutional responsibility, in real terms, and as you said, with the real economy, what does this translate to?
Well, it's one of the typical things that we all know in economics. Excuse me, there are always trade-offs involved and opportunity costs and choices. And invariably, when you choose to address one issue, chances are it will be more negative for others. So it's a question of weighing up pros and cons and priorities. Again, without belaboring the point, the Reserve Bank's view, shared by many, is that yes, indeed, an increase in interest rates could be painful, but in the longer term, it does pave the way for a more stable macro and financial economic situation, which in turn is a necessary condition for future economic growth. We also have to consider the fact that if other countries, such as America, are going to be raising their interest rates and we did not do so, then there's a good chance that the exchange rate would depreciate, bringing with that some negatives as well. So it really is a question of trade-offs, but you're quite right. I mean, if and when interest rates go up, there's going to be a huge choir of dissatisfaction amongst many members of society. Many people will be very happy, by the way. Those who rely heavily on interest as a major source of revenue will welcome an increase. But you're quite right. In the short term, it's bound to be painful. But as I say, it's supposed to pave the way for a more stable economy, a more price-stable economy, a more stable environment, paving the way for future economic growth.
Okay.
You must also bear in mind, in a few weeks' time, we have our budget speech. And, already levels of government debt are exceptionally high, which in its own right, of course, is inflationary. So the Reserve Bank will probably also have to consider raising rates to compensate for that.
Okay. So, Andre, I want you to hold on. When we come back, you've mentioned how the decisions with the U.S. Federal Reserve have ripple effects with emerging economies such as South Africa. But I want us to go a bit deeper into that and see how these economies can sort of shore themselves up from the shocks that come along the way. Then beyond that, we'll also look, of course, at how other people, Nigeria decided to hold on, keeping rates steady. What other options may have been possible for the South African Reserve Bank to take in approaching this situation? So please just hold the line. You're watching Business Edge, and we're looking at the expected increase that's coming from South Africa's repo rate conversation today. The Monetary Policy Committee of the bank is meeting. We'll have that decision in a number of hours, but we're projecting into how that could play out for the most advanced economy on the African continent. Stick around. And still with me from Cape Town, South Africa, is Professor Andre Roux. He's the lead lecturer in economics at the Stellenbosch University Business School. And we're looking at the expectations for the decision on South Africa's repo rate. Now, this increase in repo rates, many say, is directly connected to the tighter fiscal monetary policy being carried out by the Biden administration in the U.S., where inflation is at a 50-year high. So, Professor Andre Roux, let me bring you back now. In what particular ways do you think that countries like South Africa, countries like Nigeria, emerging economies can sort of protect themselves from having to fully experience the shock or the decisions that come from outside of their economies?
Yeah, that's a very important question, of course. If we consider countries in sub-Saharan Africa in general, then we know that a big part of their economic activity and growth and employment is very heavily reliant on either the extractive industry and or oil and or agriculture, so-called raw material, if you like, or natural resources. And we also know that in many countries to this day, in sub-Saharan Africa, there's a tendency to sort of dig up these things and export them in their raw form to other countries who then add value and they get rich because they get wealthy, and we simply have to rely upon the crumbs that we've managed to earn from the raw material. That's a well-known factor. We don't add value. But it does catch up with us in many different ways. One of them is that when the world economy is in a bit of a slump, then broadly speaking, the demand for such resources tends to subside, and therefore we earn less, even less than before, for these resources. So just that structural factor puts that as a disadvantage. So part of the answer to your question is, and of course it's not an overnight resolution, but we need to start adding value ourselves. so to reduce our reliance on the fluctuations of commodity prices, which are generally out of our control. However, in the absence of that, in the shorter term, a very important buffer, if you like, for countries in, let's say, sub-Saharan Africa, is actually seeing your currencies weaken. It does have its downside, but it helps to maintain the attractiveness of our resources for international buyers. And then another issue, another consideration, of course, which we find anywhere in the world, but let's talk about South Africa, as mentioned earlier, is the policy or almost the strategic approach. What is the important policy variable? Clearly, as I've said earlier, constitutionally, inflation must be kept under control, and that's the Reserve Bank's job, whether they like it or not.
Yeah.
And sometimes they probably don't like it. But they have to be true to the Constitution, to prove the sacrosanctity of the Constitution.
Okay.
But to go back to what I was saying, the general story is that we need to change the structure of our economy and add value to our natural resources.
All right. So we've seen Nigeria, for instance, be able to maintain a relatively stable sort of situation due to the central bank holding its lending rates to support economic recovery in the country. Is that not an approach that the central bank, the South African Reserve Bank, could have taken? Were there any other options for the SARB?
You mean to address inflation?
Yes, yes.
Well, not really, because some of the factors contributing towards inflation are beyond our control, such as the oil price. The exchange rate, unless we intervene, tends to weaken or sometimes to strengthen significantly. So from the Reserve Bank's point of view, the only really meaningful weapon they have is using interest rates. Having said that, I think it's sometimes unfair that the Reserve Bank has to take the flak for acting as it does by raising interest rates when large parts of the inflation basket are actually beyond their control. As I've just said, oil price, Reserve Bank can't control that. The Reserve Bank cannot control wage increases. The Reserve Bank cannot control what we call an increase in administrative prices. But yet the Reserve Bank is held responsible for keeping inflation under control. So if we could, if those other factors could be addressed by other parties, that would reduce the imperative for the Reserve Bank to use its monetary policy to influence inflation.
All right. So finally, as we wrap now, the meeting is in a few hours if it has not, in fact, started, but the decision will come shortly. What do you think is likely to come out of this? All of the economists seemingly are agreeing that South Africa is heading to 4%. Is there any possibility of the rates either being maintained from the figure at November or even, let's say, out of the blue being reduced? What's your projection for what the MPC will decide today?
Yeah, but they actually started meeting yesterday, and yes, the governor should emerge in 2 or 3 hours' time and speak to the media. I think a drop in interest rates is totally off the table. That's not going to happen. So we're left with two options: unchanged or a slight increase. We don't know what happens in those meetings exactly. We don't know what additional data they might have at their disposal. But given what is available in the public domain, given the way we understand their way of thinking over the past few years, my best bet would be we are going to see that 25 percentage point increase. The only thing that might prevent that from happening is they might decide to wait until the next meeting and see what happens in the forthcoming budget, which is sometime in February, and whether they might decide. But I doubt it. I think that we are going to see an increase this afternoon.
Okay, we'll be expecting, of course. Go ahead.
Which guarantees it won't happen. As you know, economists are terrible in making predictions.
No problem. I'm asking you to look into a crystal ball. Professor Andre Roux, thank you so much. We'll be watching very closely. And as you said, a lot of eyes will continue to be on South Africa coming out of recession with vaccinations, with restrictions somehow starting to loosen. We want to see how things develop with the continent's most advanced economy. And we look forward to having you back.
Very much.
All right, thank you. And it's very clear that what we can agree on is that when Western economies tend to sneeze, Africa can catch a cold. And if you take away nothing else from this conversation, it's time for Africa's emerging economies to make sure that they find a way to insulate themselves from the shock decisions of the West. Some of it involves adding more value along the value chain of our natural resources. You're watching Business Edge. Up next is NC4 to watch. And with the stories we're keeping our eyes on, we start with oil. Now, Nigeria's oil industry woes are starting to capture the attention of bond investors. This week, the cost of insuring the country's dollar bonds against default jumped to the highest since October 2020, after Africa's largest crude producer delayed plans to cut expensive gasoline subsidies by 18 months. Nestle Food Company says it will start paying cocoa farmers cash if they send their children to school rather than out to the farms. A recent survey by the University of Chicago found that 45% of children in the Ivory Coast and other cocoa growing areas were engaged in child labor. And the International Air Transport Association has released data for global air freight market showing that full-year demand for air cargo increased by 6.9% in 2021 compared to 2019 and 18.7% compared to 2020, following a strong performance in December of 2021. And this was the second biggest improvement in year-on-year demand since IATA started to monitor cargo performance in 1990. And finally, as a group, Africa's 18 wealthiest individuals saw their combined income increase by 15% in 2021 compared to the previous year. South Africa and Egypt both have 5 billionaires on the Forbes richest list, followed by Nigeria, which has Africa's richest man and 2 other billionaires. Morocco has 2, while Algeria, Zimbabwe, and Tanzania have 1 billionaire each on the list. And that's Business Edge for today. I'm Tolulope, Adeleru-Balogun. Thank you so much for watching. Follow us on social media, download our mobile app, subscribe to our page on YouTube, and make sure you don't miss any of the conversations coming from here on the continent. Have a great day.